Hi everybody. Good morning. Or I guess in some places, good afternoon. But I'm Laura Robichaux. I am actually in the Phoenix office. We're sitting at a warm 50 something here, probably in the 70s in a couple days. So I just like to rub that in for those people that are calling in from where there's like a foot of snow. I am the state and local tax director at Eide Bailey. I've been with the firm for, at least three and a half years. Prior to that, I worked at the Arizona Department of Revenue and at the Idaho Tax Commission. I am what I consider myself to be a sales tax nerd. I love anything and everything sales tax. The messier, the better. I tend to do quite a bit in audit. I do quite a bit in taxability. Some of the major industries that I work in would be technology. I do a lot in construction. And then I do quite a bit, obviously, in the new e-commerce world. So that's kind of like a little bit about me. I'm going to turn it over to Lauren to introduce herself.
All right. Hi, everyone. My name is Lauren Taylor. I'm a SALT Senior Manager, and I actually sit in the Denver office. Laura likes to rub in the nice weather, but at least we get sunshine here. So it's always a good thing. I have been in public accounting for about 12 years. Majority of the time spent on the federal side, working heavily with multi-state corporations, and recently switched over to the SALT side to explore my passion in state and local tax. So I'm looking forward to diving into income tax here after Laura's done with sales tax.
Thanks, Lauren. Let me see. Okay, good. Perfect. So I'm not going to read through all these, but pretty much today we're going to really get into sales tax. Now, there's been obviously a lot of legislative changes. Many of you have maybe heard of it or maybe you haven't, but at least you've heard of Wayfair. So if you've sat in this presentation, and I do this, I don't even know how many times a year. I've actually changed it up towards the end of the year to make it very almost like planning. So what I'm going to talk about and go through is I'm going to touch base on all the different types of Nexus, because it's important to figure out, what creates that link. And then I'm also going to touch base on, if you're a CFO or you're a controller and you're trying to figure out like, okay, how do I move forward? What's my next step? We're going to kick through all that as well. So, um, really quickly, Nexus is just a creation, and it's the term that's used by quite a bit of states and definitely in this industry to say, hey, you have a requirement to collect sales tax and file in a state. Now, there's a lot of states that have different types of Nexus. Everybody has physical Nexus. Everybody, for the most part, I would say the majority of them now have economic Nexus, and that was kind of like what the whole Wayfair deal was. However, there are a couple of states that have affiliate Nexus, click-through Nexus, and cookie Nexus. Cookie Nexus is my favorite one. I think we can thank Massachusetts for that. That's just not a cookie like what you would think like a chocolate chip cookie. A cookie Nexus is, anytime you go to a website and it says please accept my cookies, there are some states that, if somebody downloads that on their phone, that essentially is tangible property and would create Nexus. So that's an extreme, but I like to put it on there just as a FYI. Some of the other things that come up quite a bit, especially if you are expanding what you do in terms of revenue, or you have a huge sales team. It's been my experience over the years that trying to get the salespeople to communicate what they're doing in new jurisdictions to the accounting people is like never a joyous occasion. So here's a couple things, just like tidbits of what if I could relay anything important. Physical presence is still there, even, post Wayfair. It's still the number one thing that I would say is, I wouldn't say catching, but causing Nexus to be triggered in a lot of states. There are some instances where if you have a 1099 employee, maybe they're not W-2, and that can trigger Nexus. If you're a contractor or you do any sort of like software, and maybe you go out and do training, just by setting foot in the state can create physical presence. Having anything delivered via your trucks creates physical presence. And then there's economic presence, which there is economic presence for sales tax and income tax. Of course, they're not the same, but for sales tax, it's really just sourcing your sales by revenue. So For those of you that are worried, these are the top 5 things. I know I went through a lot of Nexus stuff. These are the top 5 things that are going to trigger Nexus anywhere. So if we're in December, Christmas is quickly approaching. If you pull your end of the year W-2 or 1099 report, look and see if those match up to where you're filing any of your returns. Now, granted, there's some outliers in there, but payroll is such a huge deal. Even if that person in payroll answers the phone or they do tech, support, or they're there just to like do bills or whatever the case may be. Anytime you do W-2, it creates physical presence in that state and you have a filing requirement. Um, I hear a lot of like feedback from CFOs and controllers is like, well, they're not a salesperson, but for sales tax, it doesn't matter. So that's the hard part and that's why when I talk about sales tax, Lauren's going to talk about corporate tax to really kind of draw the line. There is a huge difference between determining Nexus. Warehouses is another thing that creates Nexus. So it could be something as basic as you maybe have some large assets or you own servers. Not you're renting them, but you own the servers, or you are a parent entity that has a subsidiary that owns a location here, but they're all under the same umbrella. All those like little things, the properties, the assets, anything that inventory wise in a warehouse is going to trigger Nexus. If you are considering selling online through Amazon, what do you call FBA, fulfilled by Amazon, where Amazon will move your inventory, then that creates Nexus. You could still sell on Amazon if you control your own inventory, but when they start taking it and moving it all over the place, then that can trigger Nexus too. And then the one that's kind of like the big wide net is the revenue. So any revenue, I'm going to go through all the different states, but generally speaking, any revenue that is over 100,000, that's not taxable. That could be both. It could be taxable and not taxable revenue. So a good practice is to just look through and figure out, okay, how much did we do in a rolling calendar, not necessarily, January to December. Okay, so we're going to kick off our first polling question.
All right, the first polling question, what are the types of sales tax nexus? You have 4 options there. If you do not see the polling question or you cannot answer the polling question, please refer to the Zoom handout that was emailed out this morning. Chances are your internet browser is not compatible with Zoom. All right, we're going to go ahead and close this poll and hear the results.
Okay, perfect. Yes. In fact, I guess you could say that there's all different types of Nexus, but mainly physical, economic, cookie, click-through, and affiliate. If you gave me 5 more minutes, I could probably name off quite a few more. And that is really just a way of the state saying, we're going to find as many ways as possible to find a connection for your company to file there. So economic Nexus, I think I already covered a lot of this. One of the big things that I do see quite a bit is if you're a wholesaler, or maybe you're a distributor, or you're a drop shipper, or maybe you sell to somebody else, you do a lot of B2B, you're still impacted by economic nexus. I have a lot of manufacturing clients or all, B2B clients that are just, gosh, Laura, I don't want to file everywhere because essentially you're filing a zero return. Now, generally speaking, there are some states that would say, well, if you don't have any taxable sales, then you don't have to file. However, the majority of them are going to say, well, if you meet the nexus threshold, you need to file at least a zero return in case there's ever any use tax, which is like a whole nother conversation. I know that everyone's going to receive the printout, but here is the breakdown of all the economic nexus thresholds with the states. So you can see that we'll have some states I've got them listed at the bottom that don't have state sales tax. I will carve out though that Alaska is a home rule state. So the state does not have a sales tax. However, there's some of those smaller cities that do have a sales tax, but generally the state does not. So you can see on the left side, there's a huge chunk of states that have economic nexus. I don't know if I have it on this presentation, but we actually have it out on our Eide Bailey website. If you were to drill into it and look under state and local tax and then search by Wayfair, we actually have a chart that has all the different states on it and the effective dates. So what you're looking at is most of the states have said, okay, $100,000 in a year will create Nexus. And then we have like, very small portion. Arizona is tiered, so it's 200,000 this year, but it's going to drop next year. And then we have states like California and Texas are both at 500,000. And I want to point those out because California's economic Nexus threshold is closely matched with their factor presence threshold on the corporate tax side. So just even by looking at the slide, you can see that a huge amount of weight of it is on the left-hand side. And nowadays, it's not that hard to get to 100,000, especially when you're in some of those larger, more higher economic states. So a couple of things that I will throw out there is every state is going to have a different effective date. California, I just had a conversation this morning about it with one of my clients, is they're considering, California, their effective date is 4/1/2019. There is a handful of the ones that were effective in 2018. There's also a good chunk that were effective 1/1/2019. So we're almost at a year where the economic nexus effective dates have already been into effect. So a common question I get is, does registering in a state for sales tax trigger filing corporate tax returns? Short answer, yes. Long answer is it depends, which is also my other favorite answer. So for those of you that have ever survived a sales tax audit, you know that sometimes when they start asking questions about one tax type, it can go into another tax type. And that's one of the weird, funky things about economic nexus is, and that's why I kind of want to slowly move into this next portion is, if you figure, okay, I sat through this SALT presentation, I've got Nexus in a couple states, I'm just going to start filing. Well, that's not, okay, we'll just kick on this slide because I'm afraid of touching too many buttons and it's going to spaz out all over the place. So one of the things we're looking at here is, here's an example of determining when you have Nexus. So let's say Arizona, just because I live in Arizona, a contractor, or it even could be a retailer, does a project in Washington in 30 days. Maybe they've never done anything in Washington before. This is their first one, yay, we're entering into a new state. Their contract price is 500K. And if you're a contractor, or even if you're a licensed provider or software, that's going to trickle over and, they're going to do certain draws over a couple of months. Washington's economic nexus threshold is 100,000 from what I can tell, but let's say it's $100,000. Does the Arizona company have nexus in Washington? Yes. One of the big questions I get, especially if depending on your industry, is what if it was like a one and done? Like we did one contract, we haven't had one since, it's been 9 months. Do we even need to file? Because once you start into a state, it's really hard to like break up with that state. So once you start filing, it's really hard to stop filing. If it's just one job, there's a lot of different options out there, but I always try to be, overly cautious. If 500,000 is, 90% of your revenue for the year, then yes, that creates a high threshold. But if 500,000 is less than 1% of your annual revenue, then the risk of not filing in Washington is pretty low. Here's my next example. So for still Arizona does something in California. California is what I call one of the bad boy states, right? A lot of companies are scared of California. They can be extremely aggressive. So for Arizona, let's say we have a retailer that does something in California. It's only 2 weeks. Does the Arizona retailer have Nexus in California? They do not. And the reason they don't is because they didn't meet the economic nexus. Now, what could throw this out the window is if you had someone or your team or someone came in and actually did work. So if they're performing like warranty work, or they're performing, any type of like maintenance where an employee enters into the state and does something, that technically could trigger physical presence nexus. Another one is figuring out when Nexus starts. So I have 2 slides on this. I'm not going to torture everybody with going through a couple of case studies, but just so you know, if you're a go-getter and you're trying to figure out, okay, so when did we actually, pierce the Nexus threshold? Here's a good way to look at it. If we know Texas, their economic Nexus threshold for sales tax is 500K. I should probably put a K behind that 500. So it's 500K. We know that it's effective October 2019. That was not even 2 months ago or 3 months ago. So Q1, you did 350. Q2, you did 100. You're getting closer at 450,000, but we haven't even hit October yet. And then we're in Q3, you hit 100,000. So the biggest question is, okay, so do I have to pay, do I have Nexus for all of Q1? So the key is you would have Nexus, you would have triggered Nexus after the effective date. And so that means that you would have a filing requirement from Q4 forward, right? So you wouldn't have to worry about anything from any of the look back periods. Sorry that everyone that was slightly painful. Okay, here's our second polling question. Economic nexus is the same across all the states that have sales tax, true or false?
All right, that second poll is now open.
Yay. Okay, I think I've driven that point home, and we're all on the same page. Economic nexus is not the same anywhere, and we all have to be careful about it. Okay, so oops, really quickly, one of the things that comes up a lot that is, I guess, not necessarily a forethought. So let's say you've identified, okay, I've got next, or I've triggered economic nexus in these 5 states. Every state, just to muddy the waters, has different sourcing rules. I mean, this is not just for sales tax. They also have crazy sourcing rules for corporate tax, and Lauren's going to dip into that. But for sales tax, there's like market-based, or you may see it called destination-based, or you may see it called like ship to. It all means the same thing. So most of the states now are market-based or destination-based, which means that you have to source your sales based off the ship to address location. So you are in, let's say you're in, I'll just say Phoenix. You're in Phoenix and you are shipping something to Utah. That is a Utah sale. Let's say that's a product. Okay, that's really easy to find for the ship to. Let's say you're a service company and maybe you do consulting, or maybe you're a tech company. The ship to address is maybe not easy to catch or pinpoint. So there's a couple different tests you can do, but the default is, okay, where is your customer located? Follow the money. Where did the money come from? If you can't identify where they used the service, then who gave you the money? Because that's your customer location. And that's going to overlap and help you also with corporate tax as well. So most of the states follow the ship to methodology. Origin based is based off of where it's coming from. So there are some states that are origin based, but everything's going towards market now. And I anticipate that to be even more in the next legislative year. One of the things is, as you enter into new states, there's some funky states that are called home rule states. And home rule states means that the state might have different, I don't want to say taxing jurisdictions, but the state and the cities are not all the same. So if you file something in Utah, you know that it's going to trickle down to the cities because you have a location code. You try to file something in Colorado, you're going to have to file a separate return for Denver. You're going to have to file a separate return for the state. Same thing with Louisiana. If anyone has had the privilege of working with a parish, you know that you're going to get killed with snail mail, and everything is different. So these are home rule states. So if you have pierced the threshold for economic nexus in these home rule states, be very careful that you may have additional reporting requirements other than what you find on Google through the state reporting. There are some software programs that are better than others, but pretty much if you trigger nexus in any of these states, just be wary that you're going to have additional filing. The same thing, a lot of people don't realize this, but the city of Seattle, you know, Washington state is not a home rule state, but there's some of their cities have their own B&O reporting, and B&O stands for business and occupation tax. So if you're filing a sales tax return in Washington, your B&O is already on your sales tax return, but if you do business in the city of Seattle, you need to file a separate return. So that's one of the things that I do kind of see quite a bit. I just wanted to mention that really fast. So really quickly, just as this is a funny example, and if you've listened to my presentation before, I use this picture all the time. So Louisiana, which they have these parishes, just to be really granular. This is not a real boat, but a boat that is sitting in between two jurisdictions. And so just so you know that your location could be in one jurisdiction or it could be in another jurisdiction. You have to be really careful. Zip codes are not an accurate way to determine a tax rate at all. And for those of you that live in Colorado, you know what I'm talking about. So just to be really careful, the tax rates are going to be different based on your address, and going down to the street address level is always the best way to sorry, I'm beginning to think it's something is seriously wrong with my computer that it keeps doing that. Okay, I'm going to click in and then we're going to hit our next polling question. Then I only have a couple more slides before I kick it over to Lauren. Many states have varying local sales tax rates. True or false? Perfect. Yes. There's so many different local rates. I think we're up to 12,000 last count. 12,000 rates in the US altogether. I wouldn't be surprised if there's more. Okay, so to kind of close this out this is my step-by-step cheat sheet, determination of if you're a CFO or a controller or you're somehow tasked with figuring out what to do. These are the steps I would suggest. So the first one is know where where you've got Nexus. Figure that one out. You can determine that by looking at the thresholds where you've pierced it and looking at your payroll and property, and then also coordinate that with your tax preparer, and Lauren's going to explain why that is so important. The next thing is, once you know where you have to collect tax, then you got to figure out a technology solution to pull the right tax rates, and you also have to register with the Secretary of State. The third step is finding the right software. Every company, there's a lot of different software solutions, but every company is going to have different needs. It's also going to depend on what your budget is. I would say if you have low transaction amounts, you don't really need like a huge Cadillac version, but that's something else. So whiteboarding a plan before you make that investment is really, really important. And then, one of the things I see is when you incorporate technology is matching what your services are. Anything that can be delineated on an invoice needs to be matched up with the tax code. And of course, there is no universal sales tax code system. Every software solution has its own tax code. So before you do implementation, you're going to need to make sure those match. Once you get those matched, then then it's all good. But matching them correctly is so important. And then the final step, as we kind of like move forward in compliance, is keeping track of any new states that you enter. That means talking to the salespeople, figuring out what they're doing. Is there going to be a new service that comes out? Is there going to be a new product? Maybe that product is, maybe you're launching a new LLC to handle, the maintenance part of your tech company. All of those things have different tax consequences. So we always recommend kind of like doing we have a diagnostic report, but just kind of doing like a double check each year to make sure that, okay, am I filing in all the right states? Am I doing what I'm supposed to be doing? That type of thing, because your footprint, especially now with the way the economy has been, is going to change year over year. It just is. The rule of thumb is if you're a company that's doing over 10 million, you should be filing in at least 3 to 5 states. And if you're not, then there's something wrong with the way the sourcing is. This is a sneak peek of what our diagnostic looks like. We have like a one pager that we take your information on, we dump it into here. We do this one pager. It's a high level overview of where you should be filing. We do it for corporate tax and income tax. So if you're interested in that, you can feel free to email Lauren or I for that. So this helps at least plan, from a state by state perspective where you should be filing. And, that way you at least have an idea of, do we need to, if you have partners, do they need to do withholding in this state, that type of thing. Here's a cheat sheet that I like to give out too, of when you enter into a new state, these are all the things that you need to be like, here's your checklist. Did I do this? Did I do this? Some states have unclaimed property. Some states have Well, actually, a lot of states have unclaimed property. Some states have business personal property reporting, which is a totally separate animal. Do they have, any other weird reporting rules? So if you can follow this 8-point checklist anytime you enter into a new jurisdiction, then you're pretty well covered in terms of risk. Okay, so just Laura's final thoughts before my computer spazzes out and I get kicked off again. There's always a ton of ways that you can create Nexus. If you have an accounting advisor or someone that you trust that you work with, talk to them about, especially this is like the perfect time of year to talk about, okay, we're planning on doing this in the next couple of months, or you're planning on selling your company, then you definitely want to look at compliance. The other thing is if you offer any new services, how do those impact? Because it does impact. Even something as simple as like online gambling can impact your taxes. And then technology. I think it's always a very like non-sticky band-aid to do everything manually. Nowadays, there's so many other options that are completely affordable. Just be open to using technology to help take care of the sales tax. And that's really the last that I had before I kick it over to Lauren. Are there any questions?
There was quite a few that came in, but we can just save them for the end if you want.
Okay.
Okay, so there's going to be some overlap, and I apologize, but we are trying to hammer in a few ideas for you today. So as previously mentioned, Nexus is a connection between a taxing authority and a business to collect and pay taxes. As similar to sales tax, income tax has physical and economic presence tests to determine nexus for businesses. So physical presence almost always satisfies nexus unless the income can be protected, which we'll get to in a minute, is protected under Public Law 86272, or the income can be possibly considered de minimis. So our basic physical presence triggers are payroll, owning and leasing warehouses or office space, owning or leasing property, and holding inventory in a state. So economic presence requires no physical presence, and states deem businesses that create or maintain a marketplace in their state to have economic nexus for income tax purposes. This can be established as easily as just making sales into a state. In order to create some clarity in the open-ended interpretation of what economic nexus is, several states have adopted a bright line test known as factor-based presence to determine if an entity has economic nexus. The general rule that was adopted by the Multi-State Tax Commission is, as you can see here, 50,000 of property, 50,000 of payroll, 500,000 of sales, or 25% of your total property, payroll, or sales in the state. So here's a list of states that have adopted the factor-based nexus rules. While some of these states follow the general rule that we just mentioned, other states have established their own factor presence. So for instance, Connecticut says 500,000 in sales creates nexus, Michigan's 350,000 in sales, and New York's up to $1 million in sales. Of the states not listed above, the determination of economic nexus can become very subjective. So in determining whether to file in these states, businesses need to evaluate matters from more of a cost benefit perspective, weighing in current and historical exposure to the state, as well as other non-tax considerations like administrative costs and time to file. So Public Law 86272 is it's a federal law that restricts a state from imposing tax on an out-of-state taxpayer if their only connection to the state is purely solicitation of sales of tangible personal property. Now, there are a couple other rules that go along with that, meaning orders are to be sent outside of the state for approval, and orders have to be fulfilled outside of the state. So keep in mind that public law doesn't sever your nexus from physical presence, but it just protects the income derived in the state. Here is a list of protected activities under public law. So, carrying samples and promotional materials for display as long as done without charge. Providing automobiles to sales personnel in the state for conducting activities that are protected under public law. There's a whole list of protected activities. This is just a few. And then here are some activities that could cause a protected sale to become unprotected. And these are examples of just additional exposure into the state. So going in and out to make in-state repairs, or doing in-state deliveries, or again, maintaining inventory in the state can all break your protection from Public Law 86-272. So it's important to note that public law applies to income taxes only. It does not protect against franchise tax, gross receipts tax, or sales and use taxes. And it's important to note that it does not protect against sales of services. It is truly just sales of tangible personal property. But we get a lot of questions into, well, if I'm protected, do I still have to file a tax return? And typically I would say where return is required is if a state imposes both a income tax and a franchise tax. So for instance, Louisiana and Tennessee both impose income and franchise tax. And you can even see on their tax return, there's a box that you check that says that your income is protected under public law. In other states that just impose an income tax, your exposure to not filing could be minimal, considering that you wouldn't have any taxable income in the state. So your exposure to interest and penalties would be minimal, if any. So polling question number 4, delivery of tangible personal property into a state causes protected sales to become unprotected. True or false? All right, so yes, the answer is true. Increasing your exposure and your contact into a state can throw out your protection under public law. Okay, so given that pass-through entities have become so prevalent and are generally not subject to entity level tax, states have searched for ways to tax the income derived by these pass-through entities from sources in their state and distributed to non-resident owners. So the basis behind this, or what creates nexus by pass-through entities, really comes down to what each state considers as doing business in their state, which can be extremely subjective. Most states currently take the position that owning an interest in a pass-through entity is by itself sufficient to create nexus. Nexus can also be created by a resident shareholder or partner's activities in a state. So for example, we had a Colorado LLC that owned rental real estate in Colorado, but they had a general partner that worked out of their home in California performing services for the Colorado LLC. And because of this fact, California considered the Colorado LLC to be doing business in the state, had nexus in the state, and owed the $800 annual franchise fee. Then, kind of going back to factor presence nexus, as I mentioned earlier with the economic presence with those handful of states, it's been interesting to see that, a company could have an interest in a pass-through entity, and when looking at their portion of the apportionment factors that would flow through to them, they would be considered to be under that factor presence threshold. But even under that fact pattern, some states would say that they would still have nexus in the state. And an instance of this would be, Alabama, they follow the general rule where they say, 50, 500 in sales for their threshold. But even if the non-resident was under that threshold, they would still say nexus, they have nexus and a tax obligation, because Alabama actually looks to the pass-through entity to establish nexus, not the non-resident. So while some states may not follow this logic, it's just important to look at the rules for each state, as well as determining what kind of activities you have in the state that could trigger nexus. Again, kind of going back to even basic, what are my partners doing for the business, and where are they sitting? So California is actually one state that is quite the headache. They say that they have a factor-based threshold, but they also uphold that any amount of interest in a flow-through can create nexus. So the SWORT Enterprises versus California Tax Board case was a big win for non-resident entities and owners in an attempt to clear up some uncertainty around what creates Nexus in California. So for those of you who aren't aware of the case, SWORT was an out-of-state company that had operations in the Midwest with no physical presence in California. But they weren't registered with the California Secretary of State. Their sole connection to the state was their 0.2% ownership of a California LLC. It's important to note the California LLC was managed, and SWORT had no involvement in operations or management. And the California Franchise Tax Board claimed that they were doing business and owed the $800 franchise fee. Well, SWORT came back and appealed, and the California Court of Appeals overturned the Franchise Tax Board and held that SWORT was not doing business in California because SWORT was acting similar to that of a limited partner, not a general partner. So this was beyond ownership percentage and more looking into the actual activity of the partner. So again, here's just some takeaways from SWORT. I won't go through all of those again, but the important piece to remember was it was more looking at not necessarily just what they owned in that LLC, but back to the activities of SWORT with the LLC. So some other considerations. Currently, 13 states take the position that the mere act of registering to do business is sufficient to trigger income tax filing and payment obligations to a state. Some other things when registering to do business to keep in mind is that it might be required to do business in the state. It may also be required to e-file. A lot of states, Pennsylvania, for instance, wants a revenue ID to be able to e-file a return in their state, and they've mandated that electronic filing is required. So those are all things just to keep in mind. And I know Laura kind of mentioned some year-end planning, but as you're coming up on the upcoming filing season, looking at not just sales tax, but looking at your property, payroll, and sales by state to determine, have we expanded operations from what we've done previously? Do filing of sales tax returns expose us to more income tax filings? And also, kind of circling back to Public Law 86-272, is have my activities in the state increased that would potentially exceed public law protection. All right, so apportionment. In general, there are 4 different methods of apportionment. As you can see here, there's a 3-factor especially weighted. I actually saw one state has a 3-factor quadruple sales weighted factor, which was interesting. And single sales factor is typically the most common formula for states these days. Here's just a map of states and what their apportionment formula is. I will note that there's been some changes recently in that Kentucky and Louisiana have gone to single sales. How do you source sales services? And there are 2 different methods. One is cost to performance and one is market-based. Cost to performance, the general rule is if the income producing activity is performed in one state, that's where the revenue is sourced. Now, if it's performed in more than one state, sales are sourced to the state with the greatest income producing activity. There's also pro rata sourcing, which is basically looking at a ratio of the cost of performance in the state to your total cost of performance everywhere and applying that ratio. Now, a lot of states are moving more from a cost of performance to a market-based source. And market-based sourcing is basically sourcing services to where the benefits are received or delivered. There's also, you can source to where the customers build or where the customer's marketplace is located. Just a quick example is, New Jersey is a cost of performance state. So you've got a New Jersey company with New Jersey employees providing a service out of state. New Jersey would say that revenue should be sourced to their state. Some listed here are some states that are market-based sourcing. And as you can see, in 2019 alone, 4 states switched from cost to performance to market-based. and there are a handful of other states coming down the pipeline in 2020 and 2021. One thing we've noticed with the states, some being cost of performance versus some being market, is for companies who provide services, there are scenarios where a company would have to source the same revenue to two different states. So for instance, kind of talking back to the New Jersey example, is we've got New Jersey employees providing advertising services in New Jersey. Well, that revenue would be picked up in your sales factor for New Jersey because that's where the performance occurred. But let's say the company they perform the work for is in Alabama, so the benefit is received in Alabama, and Alabama would want that same revenue in their sales apportionment as well. Sourcing of sales of tangible personal property. This is fairly straightforward in that you would source the sales to where the property is delivered or shipped to where the final purchaser is. That's what's referred to as the destination test, and Laura kind of mentioned that with sales tax. The other option is what we call a throwback rule, and I'll walk through a little two-step process with that. But essentially, there's an option to be able to throw back those sales to the state in which the tangible property was shipped from. So throwback rule, part one. So we have to look and say, was the tangible personal property shipped from a store or factory or place of storage in the state where the throwback rule applied? And if that is true, then you have to look to the next piece and say, is the taxpayer taxable in the state where the tangible property ended up? And essentially, it's pretty basic in that you're looking at it from, if I'm in Colorado and I ship property to Louisiana, would Louisiana say I have income tax or a franchise tax filing? Meaning, do I have payroll or other property there? Do I hold inventory there? And if I don't, then the idea being then I could take those sales and push them back into Colorado and not into Louisiana. And here is just a map of states that either have a throwback rule or don't. And then you have your outliers or your gross receipts tax or no tax states. Okay, so as Laura mentioned, this is very similar and just kind of play off of what she mentioned at the end of her presentation with sales taxes. Registering for sales tax can put you on the radar in many states for an income tax filing. Now, just because you pay sales tax to a state doesn't necessarily mean you owe an income tax. There are always different scenarios. For instance, if I may owe Michigan sales tax, but for income tax, my sales are protected under public law. So just things to consider, and it's always good to know, where am I been filing from sales and income tax, and just where am I going, and keeping all of those things in mind, that they are becoming more related than in the past. So with that, I will leave you with our last polling question, and that is, I would like to see future presentations on, let's see, economic nexus implications for sales tax collecting and remitting, state income tax implications of federal tax reform, or surviving a state sales and use tax audit. Not thinking about it, I should have put D, all of the above.
Pretty good mixture there.
Yeah.
Great.
Awesome. Well, thank you for your feedback on that.
So let's see. Our first question here is for Laura's section. On the economic nexus, are you meaning just in the state, or is there an entity total for less than 100,000?
That is a great question. I always say for sales tax, it's by EIN. So if you have multiple entities and one overlaps with the other, if they have separate EINs, that's how you have to look at it, because you can have a ton of entities owned by a parent company, but if they all have separate EINs, that is usually the rule of thumb of how you break up the income.
Would you recommend starting to file zero balances ST and UT returns to start the clock ticking for statutes of limitations for audits?
That is a great question. Okay, so the answer is you could do that, but for sales and use tax, it actually doesn't matter because if you filed zeros, but maybe you're just, I guess it doesn't matter if you get the clock started because if you are underreporting by 25%, they can go back and keep going back. So I guess it just, if you wanted to, you could, if you have the resources to do that. But I think it's always, to me, it seems like you're going to put effort forward. You just probably want to get making sure that when you do start filing, that it's accurate. And plus, zero returns can sometimes cause triggers in some states. Like, well, Arizona, it's not going to cause a trigger at all. But if you start filing zero returns in Colorado or Utah, they're going to flag that.
Should I care about sales tax and Nexus if my customer has an exemption state tax certificate?
Yes, because the number one reason why people get assessed in audits is because the auditor has disallowed the exemption certificate. If your exemption certificates are valid, they're signed, they're properly executed, they're completed, they're up to date, they have all the right dates on them, they're from the right company name, they're signed by the right people, and you feel good about it, yes. But if you don't feel good about any of those things I just listed off, it's always a good practice to run through it once or twice. Just make sure that you've got the forms correctly filled out. Some states like New Mexico and Florida, their exempt certs are issued from the state, and then you have other ones that you could just pull it down from Google and fill it out and send it in. If you're audited and your exemption certificate's incomplete, the auditor could potentially tell you, okay, this is wrong, you either need to get a new one or we're going to charge tax on it. So just, I mean, don't do it every month because that's kind of overkill, but at least once or twice a year, comb through those things and make sure that they're correct. And if they're not, send out letters and say, hey, we need an updated one.
Are there resources available that summarize by state what types of entities can qualify for state tax exemptions?
Yes and no. Yes, but probably have to pull a couple different charts for that. But yes, there are. I don't know if there's anything free on the internet. I'm sure you could find it. I don't know if it's up to date, but yeah, there's a couple of ones. If you need something and you're a client of Eide Bailly or you're not, you can always email Lauren and I, and we can try to pull some charts together for you. But as far as one resource, I don't know of one.
And then this one says, what about the situation where a company hires a trucking company to deliver property to another state? Does the delivery subject the trucking company to income tax in the state it delivered to?
Company hires a trucking company to deliver property into another state. So like third-party shipping. Okay, let's just say that, or delivery. Does the delivery subject the trucking company to the income? No, because if something happens to the truck, you're still kind of responsible for whatever's on that load. Usually, if you're trying to see if you can pass that income to the trucking company's not getting any income from your customer, right? You're getting the income, so that's why you can't, I guess, reroute the sourcing of the money. It'd be different if the company who purchased it is felicitating the delivery, but I mean that's kind of one of those questions where it's hard to tell without like a little bit more detail, but I would say generally no.
All right, one last question here. How often should you request a new exempt certificate from customers?
Every year. Even if you have a blanket one, just get one every year if you can. I know some people put one on there with the dates that say blanket or forever or in perpetuity. I've just been through too many traumatic sales tax audits where it's like not even worth it. So I would say every year. Do it every January, make it part of your, sales tax process if you have one, just to be on the safe side.
Awesome. Well, that is all the questions that have come through. So thank you to Laura and thank you to Lauren. And thank you all for attending. We hope you have a great day.